Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. I am your host, Dan Sipe. Additionally, as you know, I'm the branch manager here at Serving Those Who Serve, Sipe and Associates, beginning as I always do with thank you. Thank you for taking the time to listen, and thank you for your service. You don't hear it enough. You'll always hear it here. I say this a lot. Feds are the glue that holds everything together. And people don't notice it until it's gone. And we're thankful that you are always there. And you know who else is always there? We can count on him as surely as the sun rises in the east. You know him as the guru. I know him as Ed. Ed Zurndorfer is back with us again as part of our mission to reach, teach, and serve you. And now I have to go into the compliance corner. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only, not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at Serving Those Who Serve. If you just need a question answered, you can submit it. You will get an answer. So, once again, we are following Ed's FedZone articles one more way for us to reach, teach, and serve. This one hits me in the heart. We've had a tough 18 months. I know I'm not supposed to break the time-space thing with a podcast. This is supposed to be timeless. But we have all collectively, as people, come through a lot. And this year we had some extra, and it's just not over yet. You know, my daughter goes to graduate school on the West Coast, so I'm watching the fires and with great deals of anxiety, and I feel for the people out there. California has one of the largest groups of feds in the United States, so folks, just know this. You know, our thoughts and prayers are with you, and we're going to be covering that the IRS recently announced tax relief for anyone affected by the California wildfires and of course, Hurricane Ida. And now we've got another hurricane buzzing right up in. So to just all the people who are in the path of these terrible disasters, you have our prayers and our best wishes and all of our hopes for a speedy bounce back and recovery from it. And hopefully what we're going to cover today a little bit with what the IRS is doing, hopefully that's going to help. So, Ed, let's begin with the wildfires. What has the IRS done?
Dan, before we get started, I just want to echo your thoughts here.
Please do.
Thoughts and prayers. And believe me, every time I turn on the news, and we watch the news religiously every evening, looking at the West, all the fires, not only in California, but Oregon, Washington, and other places in the West, my heart goes out to those federal firefighters. When you said
absolutely
thank you for your service, that's what I keep thinking about. In the West,
absolutely.
The firefighters, with the hurricanes, the recent hurricanes that devastated Louisiana and the Northeast, the feds who are helping out, in particular in the Federal Emergency Management Agency,
absolutely.
FEMA. I cannot thank those employees. There's not enough thank yous to go out for their dedicated service. Because this is just heart-wrenching to see what the people in these areas are going through. And it just seems like it's endless. The California wildfires, it just seems like it's an endless, the record keeps going on and on. And I don't remember a year we had so many hurricanes and tropical storms that are affecting people in the South and the Northeast. I just don't remember a time. So again, my thank yous for your dedicated service. And again, I think the nation really applauds your efforts, what you've been doing.
These are people who run towards the trouble. So, absolutely. Applause right there. So let's see what the IRS has been able to do to help some people out here.
IRS, yes, Dan. The IRS announced that victims of wildfires that began the most recent round on July 14th will get some tax relief from the IRS. We're talking about, when I say victims, people may have lost their homes, lost entirely, or they lost records, important personal records like financial records, things like that. Any victim of a wildfire that goes back to July 14th, 2021, they will have until November 15th, 2021, about 2 months from now, to file their individual, and if necessary, they have a business tax returns, and make any tax payments that have filing and payment deadlines anytime after July 14th and ending November 14th, 2021. For example, if an individual filed an extension for their 2020 federal income tax return, the original deadline was May 17th this year. The IRS extended it 1 month, and they filed for an extension. They have until October 15th, 2021 to file their 2020 federal income tax return. They will have until November 15th to file their 2020 federal income tax return.
Gotcha.
Also, there is a quarterly estimated tax payment. There are some individuals who have to file what's called quarterly federal, sometimes state estimated tax payments, and they file quarterly. The quarterly payments are due. The first one is due April 15th of the year. The second one is due June 15th. The third is actually due September 15th. So if a victim of a wildfire was due to pay an estimated tax payment for 2021, that's due tomorrow, September 15th, they also have until November 15th to make that third quarter estimated tax payment.
Gotcha. Okay. Now let's move from the West Coast to the Gulf Coast and beyond, because Ida swung all the way up through the country. What relief for any of our feds and everybody else for that matter for being affected by Hurricane Ida?
Okay, the IRS announced that victims of Hurricane Ida that began on August 31st, 2021, they have until January the 3rd, 2021 to file various individual and business tax returns and make any necessary tax payments with no penalty. So that would include, Dan, the third quarter federal estimated tax payment due September 15th, as well as the 2020 federal income tax filing deadline, assuming they filed for an extension that was due October the 15th. That normally is due October 15, 2021. They have until January the 3rd, 2022 to file those returns and make any tax payments without being subject to any type of penalty.
Gotcha.
Late payment penalty.
Gotcha. And hopefully those actions will help bring some help and relief to anyone who may have fallen victim to those terrible events. Now, Ed, you kind of closed out your article with something I got to admit I had never thought about. And you said that in the article, the IRS is urging people to prepare for natural disasters. Why don't you walk us through some of that? Because there were some pretty good ideas, and I got to admit I'd never thought of them.
Okay. Well, let me just say this, that the month of September has actually been designated as National Preparedness Month.
Okay.
National Prepared Month. And I can't think of a better month because September is the height of the hurricane season. August and September are the height of the hurricane season. And we know with the wildfires in California, usually the wildfire season normally starts in September. It started earlier this year out there in California. So with this in mind, IRS is recommending that people have what's called a preparedness plan to anticipate what's going to happen if they are the subject of any type of disaster, whether it's a fire or a flood from a hurricane. It could be a tornado. It could be even something like an earthquake. We don't hear too much about earthquakes, but
sure.
These things do happen in this country.
Oh, sure.
Therefore, we have to be prepared for this. And the idea is being that individuals should make their personal residences and business necessary, what I call disaster, making their residence and businesses disaster in the sense that they're protecting any personal items and documents. And I have a few suggestions in order to do this. The first suggestion I have is start secure. I put the word secure in quotes. Mm-hmm. Individuals should keep critical original documents inside waterproof containers in a secure space. What are included in these documents? Tax returns, birth certificates, deeds, titles, insurance policies, and they should actually also be duplicated and kept with someone else, kept with a trusted person outside the area where a natural disaster may affect. Mm-hmm. Talking about tax returns, I have copies of my tax returns going back to 1985, Dan. 36 years worth. Do I have them on paper? No, because anytime I file a tax return, I make copies of it. I convert it to a PDF file and put it on a thumb drive. And that thumb drive contains copies of my federal and state tax returns, my business returns, and I actually use two thumb drives. The one thumb drive I keep locked in a fireproof file cabinet, and the other thumb drive I keep in my safe deposit box at the bank. Okay, so therefore I have two secure places where I have a backup of all my tax returns. But it's more than just tax returns here. We're talking about things like your copy of your Social Security card, birth certificates, things like that. Things that you may need sometime.
Sure.
Title to your house, deeds, things like that. You should keep copies of and keep in a very secure place, like a file cabinet that's fireproof, something like that. I call it start secure.
No, that's. Like I said, as I read that, I was like, this is really good stuff. And a lot of it I had not thought of.
Next item is, and as I say, make copies. If you have original documents only available on paper, you should scan them, save them on a USB flash drive, a CD. I haven't used a CD in years, though, Dan. I use flash thumb drives.
Sure.
They're a lot easier to work with. Or, for that matter, in the cloud. The cloud's getting more available, okay?
Yep.
Which provides securities and easy portability.
Gotcha. No, great ideas. Just close on this whole section with, once again, for Ed, myself, and the crew at Serving Those Who Serve, you're all in our thoughts and prayers, whether you're out in the west dealing with the wildfires or you've just come through the hurricanes or they're facing you now. Thoughts and prayers as you work to recovery. Ed, we've got some time remaining today, and I thought we'd take a little bit of time on one of your newest articles, hasn't even come out yet, and that has to do with the changes in the rates for the federal employee group life insurance program. And I got to say, this one's different for me. 35 years, I've seen a bunch of rate changes, but this is the first time I can remember one that includes a cost increase in the cost of basic life. So the other thing I'll toss in here, folks, absolutely. This is one where you need to go to the Fed Zone, fed-zone.com, because Ed's tables in there are dynamite, and they're going to be able to show you what it was and what it is. It's great to hear something change, but you really need to see what it is. And this is all coming pretty quickly, October 1st, right, Ed?
That is correct. I just want to say this. In our previous session, we talked about September being designated as the National Being Preparedness Month, being prepared.
Yep.
Well, September, Dan, has always been designated as Life Insurance Education Month.
There you go.
This is also an appropriate thing here. Well, let's talk about this recent change. Last week, OPM came out with what's called a Benefits Administration Letter, BAL, in which they said that effective October 1st, 2021, FEGLI rates are going to change as of October 1st, 2001. Now, when I say change, I didn't say increase, I didn't say decrease. There's going to be changes because some of the FEGLI coverages will go up in cost and some will actually go down. Let's just review here what is available at FEGLI. If you're a federal employee, you're eligible to join the Federal Employees Group Life Insurance. When you were first hired, believe it or not, you were automatically enrolled in what is called the FEGLI Basic Life Insurance, which is nothing more than your salary at the time, and your salary changes over time, so your coverage changes. It is your SF50 salary, your standard form 50 salary, rounded up to the next $1,000 plus $2,000. So, for example, if you're currently enrolled in the FEGLI Basic Life Insurance and your current SF50 salary, let's say, is $92,300. That's your SF50 salary.
Gotcha.
Then your FEGLI Basic Insurance amount, let's take $92,300, round it up to the next $1,000, which is $93,000, and add $2,000. You have $95,000 worth of FEGLI Basic Insurance.
Gotcha.
FEGLI Basic Insurance. And as your salary goes up, for example, President Biden has recommended, I believe, a 2.57% pay increase for federal employees effective the first day of the new leave year, which is January 2nd, 2022. So
gotcha.
your SF50 salary will be going up by, on average, about 2.57%. Therefore, so will your FEGLI Basic Insurance amount. If you get a job promotion, you get a step increase, your SF50 salary also goes up, and so does your FEGLI Basic Insurance amount.
Gotcha.
Now, those rates, as we're going to find out in a few moments, those rates are the premium rates for FEGLI Basic Insurance amount will be going up. We're going to talk more about that here in a moment. The other type of FEGLI coverage is what's called the optional coverages, Dan, which include option A, which is the standard flat $10,000 of life insurance. That's a flat $10,000 of life insurance. Option B, which is a multiple of one's SF50 salary, 1, 2, 3, 4, or 5 times that SF50 salary as adjusted up to the next $1,000. So my example here, where the person has a SF50 salary of $92,300, they could be enrolled in option B and have 1 times $93,000, 2 times $93,000, 3 times $93,000, 4 times $93,000, or 5 times $93,000. That's
gotcha.
Option B. And finally, you have option C, which is family coverage. An employee can purchase life insurance on a spouse, multiples of $5,000 on a spouse, 1, 2, 3, 4, or 5 times $5,000 coverage on a spouse, and coverage on children under the age of 22, multiples 1, 2, 3, 4, 5 times of $2,500. That's called option C.
Gotcha.
Employees have that opportunity to enroll in the optional coverages. And we'll talk about what's going to happen to those premiums as part of the discussion, what's going to happen, as far as what's going to happen after October 1st, 2021.
Gotcha. So let's dig in with the basic. For rank and file feds who are working, looks to me like it's about a 6.6% increase. Is that the way you saw it?
That's correct, Dan. Before we get into these specifics of these increases, I just want to say that that the rates are going to change effective October 1st, 2021, and federal employees who are enrolled in the various coverages we just described, these rates will take effect on the first pay period of October 2021. According to my calendar, the first full pay period starting after September 30th, 2021 will start on Sunday, October the 10th, 2021. In other words, the federal employees are not going to see these increases or decreases in their premium rates until their first pay date after that pay period, which will be sometime in late October.
Gotcha. Okay,
right.
So first up, we got the basic.
The basic. All right. So currently, right now, an employee enrolled in the basic insurance amount is paying. What they're paying is each pay date for every $1,000 of coverage they have under FEGLI Basic, They are paying 15 cents per $1,000 of coverage every pay date. So, for example, if they have $100,000 of FEGLI basic, 100 times 15 cents, $100 times 15 cents times 100 times 15 cents per thousand, because they have $100,000 of coverage, means they're paying every pay date $15. $15 every pay date, Dan.
Yep.
Effective with the new rates in October, it goes up to 16 cents per $1,000 of coverage. That same employee who has $100,000 of FEGLI basic will be paying $16. That's a dollar increase per pay date, or with 26 pay dates, $26 more per year. So you're right, Dan. It's a 6.6% increase, because you're talking about $1 over $15 is about a 6.6% increase.
Gotcha.
Now, what employees have to keep in mind is that they are paying 2/3 of the premium cost, and their agency is paying the other 1/3 of the premium cost. In other words, we said that the employee is paying 15 cents per $1,000 of coverage for every pay date. The agency is contributing 7.5 cents per $1,000 of coverage. In other words, the total cost of FEGLI basic every pay date is 22.5 cents per $1,000 of coverage. The employee is paying 2/3 of that, which is 15 cents per thousand, and the agency is contributing the other 1/3, which is 7.5% per thousand. Come October 1st, the agency will be paying 8 cents per $1,000. The employee is paying 16 cents for a total cost of 24 cents per $1,000 of coverage. I have to tell you, Dan, and this is not in my article, but I will tell you that when an employer, in this case the federal government, is paying part of the cost of the group life insurance policy, FEGLI in this case, there are tax consequences.
Yep.
And I'm going to be writing in my next Fed Zone column, this will be my 4th column for September, it's going to be entitled The Tax Consequences of Employer-Sponsored Group Life Insurance and How It Affects FEGLI. I say that because, as you know, Dan, I am an accountant. I have a tax practice.
Yep.
And one of the questions I get from some of my federal employees from their W-2s, they say, I saw something on my W-2 I don't understand. And I said, what's that? Well, here in box 12, it has a code C. And the code C refers to the cost of employer-sponsored life insurance. What is this all about? And I have to go through exactly because you're enrolled in the FEGLI Basic and your agency is paying 1/3 of the cost, you are taxed on that.
Yep.
And I'm going to be discussing that, how they're taxed on it, in this upcoming Fed Zone column. It'll be out probably in the 3rd week or 4th week of September.
How about on a webinar?
Well, it's funny you asked that, Dan, because
I thought it was.
It's very fun. We have, as part of the Serving Those Who Serve webinars, a FEGLI webinar. It's not just FEGLI. We talk about life insurance.
Yep.
Our next FEGLI webinar will be held. We just had one, by the way, but we're going to have another one. I'll give you the date. It's November 12th, 2021, in which I will incorporate the new FEGLI rates. I do talk about tax consequences. We talk about other aspects of life insurance, how to buy it, where to buy it, that type of thing. And we do talk about the tax consequences. But I had to put that plug in here because it's very important that employees who are enrolled in the FEGLI basic insurance amount be aware that the government contribution, most of it is subject to taxes. They got to pay a tax on that employer-sponsored benefit, the portion of their premiums that are paid by the government.
Gotcha. Okay, so the Fed's contribution's going up, Uncle's contribution's going up. And that also means that the folks who are retiring and want to hang on to any basic beyond the 25% that you'll get for free if you've held it for at least 5 years. So they're going to pay more too, right?
Yes, and the rates for annuitants are going up. Anybody who is retired or who will be retiring will be paying more for their FEGLI basic insurance amount. But I have to tell you, Dan, that FEGLI, if one retains their FEGLI basic into retirement, all of it, they're going to be paying a high price. This is in general. It has nothing to do with the change of cost, the change of rates in general. This is general. Let me give you an idea of what we're talking about here. That if a federal employee who has been enrolled in the FEGLI basic for at least all of the last 5 years leading up to their retirement date wants to retain 100% of that benefit, like my example, the employee has $95,000 of FEGLI basic. Let's say they're going to retire this coming December. It's going to be a very popular retirement date, December 31st, and they decide, they want to keep all $95,000 into and throughout retirement. The cost to them is going to skyrocket. They're going to be paying approximately 9 times as much in life insurance for the FEGLI basic as they were when they were employee. I repeat, 9 times as much.
Sure.
So I caution employees to think about their life insurance needs, and we do talk about this during the FEGLI webinar. What is the purpose of life insurance? Why do you have it? And is it really necessary to keep that full amount that you had while you're an employee into retirement? Because if you're willing to reduce the amount of your FEGLI basic, believe it or not, it'll actually become free. I said free, Dan.
I heard that.
And how does that happen? That if a employee, when they retire, makes the election to reduce their FEGLI basic insurance amount by 75%, they're going to take a 75% cut in the amount of their FEGLI basic. An example here, person I was talking about has $95,000 of FEGLI basic when they retire, and they're willing to reduce that by 75%, which means probably they're going to have about $24,000 of FEGLI basic.
Yep.
Then, when they become age 65, if they retire before age 65, or if they retire after age 65, immediately they pay no premiums.
Yep.
It's free life insurance. Yes, I said free.
Yes, I know, Ed. And see, I'm a glass 25% full kind of guy. So whenever I talk to our feds, I will say, you get 25% of this for free. I know technically speaking, I have to say, and when the time comes, you elect the 75% reduction. Well, that still leaves 25% for free. So I agree with you 100%.
So that's an election. But until age 65, until they reach 65, they'll be paying a monthly premium with full coverage, I should say, but they're paying the same amount, that 15 cents, well, it's actually 32.5 cents per month per $1,000 of coverage, not 15 cents every 2 weeks, but 32.5 cents. But that rate is going to go up next month to about 35 cents per $1,000 of coverage.
Gotcha.
Okay, that's the 16 cents every 2 weeks. It's about 35% every. There is one other election, Dan, that one can make in order to not pay an exorbitant amount for FEGLI basic, and that is what's called the 50% reduction. The 50% reduction. But this one is not free. You have to pay a higher premium than you did when you were a Fed, even with a 50% reduction. And that rate is going to jump up again starting after October 1st.
Gotcha. So, okay, so that pretty well covers the basic side of the house. And let's move on to, this is because, again, you know me, I'm a geek for this stuff. This goes to the option that I get more questions about than any other as far as, I wonder why that's that way. and that would be option A, which is the standard amount, $10,000. Because I'm, again, a little geeky for this stuff, a little bit of a historian, this goes back far enough in the origins of the Federal Employee Group Life Insurance Program, and people just forget that there was a time in this country where $10,000 was a home mortgage. It's hard to imagine that, but there was a time. So in the original idea of this, it was a nice little chunk to add on because there were actually feds that didn't make $10,000 a year. That's how far back the FEGLI program goes. So let's go ahead and talk about the option A, flat about $10,000. And much like basic, it also has that provision to keep a little bit for free in retirement. But let's talk about the cost right now.
Okay, federal employees who are enrolled in option A, first of all, they have to be enrolled in the basic. You cannot have any of the optional coverages, A, B, or C, unless you're enrolled in the basic, in the basic insurance package. I have to mention that. Yep. Option A, as you say, is a flat $10,000, and the cost of the FEGLI for the FEGLI option A depends on your age. The various optional coverages we're going to talk about have what's called age bands, and depending on what age band you're in will determine what you're going to pay for these coverages. And it's, as you can imagine, with $10,000 life insurance, the option A is not all that expensive. For people under the age of 35, they pay 20 cents every 2 weeks. 20 cents, yes, every 2 weeks, approximately $4 a month. And as you get older, it goes up by 10 cents you jump into another age band, like you go from the next age band is 35 to 39, 40 to 44. It goes up by 10 cents when you jump into another age band until you're about age 50, where it goes up by about $1 every month. So somebody who's between 50 and 54 is paying $1.10 for the $10,000 of coverage. This is every 2 weeks. And when you're age 60, it's $6 every 2 weeks, approximately $13 a month, and it stays that way. It stays that way as long as you are an employee. Now, when you retire, though, with option A, you have this option where you could reduce it by 75%.
Yep.
And it goes from $10,000 of coverage to $2,500 of coverage, starting when you're 65, and at that point, FEGLI option A is free, no premium. Yep. So that's $2,500, and if you put it together with your basic option A 75% reduction, that could be a nice chunk of change that could be used for burial fund.
Sure.
Burial fund, and it's free. It's
absolutely free. Yep.
In terms of what's going to happen after September 30th with the new rates, there's only some slight changes, but I'm happy to report, Dan, that the cost of option A will either stay the same for people under the age of 35, people over the age of 60 who have option A, employees I should say, are not going to be paying any more for option A. And
Gotcha.
If you're between age 35 and age 59, the cost is actually decreasing.
Yep.
About 10 cents every 2 weeks. 10 cents less you have to pay for option A if you're between ages 35 and age 59. So there's a decrease here.
Yep. That's a nice little drop. Okay, so next up, we've got what tends to be the biggest chunk for people who participate in this. That would be the optional coverages. And as you correctly identified, round up the salary, multiply 1 through 5, add it on. And we've got a little bit of a mixed bag there. We've got mostly decreases, but one increase. So let's talk about that.
Okay, option B is a multiple of one's salary. Getting back to the example here where the person had $92,300 of a SF50 salary, we said that explain what their basic life insurance is, but option B is you can have 1, 2, 3, 4, or 5 times multiple of their SF50 salary rounded up to the next thousand. So if their SF50 salary is $92,300, then they could have multiple 1, 2, 3, 4, 5 times of 93,000. And the cost for option B, again, depends on your age. They have what's called age bands for people under age 35, and it goes all the way out to employees who are over, believe it or not, over age 80. I got to tell you, Dan, I've looked at that. This option B, when you get to be age 55, it's going to skyrocket in costs. Skyrocket. It's a big jump. Very expensive. Big jump when you reach age 50. And what I tell employees during webinars and seminars, FEGLI, is that if you have option B and you've reached your 55th birthday, you better think about why you have this option B. Either reduce it or drop it, because you probably don't need it and you're paying a lot of money. You're paying a lot of money. One can drop the optional coverages at any time. You don't have to wait for an open season. And if you really don't need this option B, or you want to decrease it, you could do it using, I got the form number, Dan. I got the form number.
Shocker.
Anytime. It is standard form SF 2817. SF 2817. In which you tell the Office of FEGLI that you'd like to decrease or get rid of option B. You're going to retain your FEGLI basic, okay, fine, because that cost doesn't change as long as you're an employee. But this option B, Dan, gets to be very expensive. In terms of differences pre-October 1st versus post-September 30th in terms of cost here, if you're under age 35, there's no difference in cost. If you are between 35 and age 74, your cost is actually decreasing. Good. If you're between 75 and 79, there's no change. But if you're over 80, it really goes up in cost.
That's a pretty big jump. It's about 9% that they added to that. Yeah. Now, one thing I just want to stress here, folks, because I got to make sure that I stay on the right side of my compliance department. Not making a recommendation saying drop it at 55. Take a look at it. Evaluate your situation. If you want to talk to us, if you just want to ask a question, get numbers side by side, understand what it is. Happy to help you with that. But what Ed is saying is important to understand, because I'll never forget, because again, I've been doing this for 35 years, and was talking with somebody and I was explaining how this worked, and he had just turned 55 and that had kicked in, and I'll never forget, he goes, "It wiped out my COLA." So it is a pretty big jump. It's a good program. You just need to understand how it all works. And I'll put on one last little bit of caution, and this is why it really helps to make sure you're talking to somebody, anybody, it doesn't have to be us, who really knows this stuff, because Ed's right about that form number, but there is a tricky component to it. You are signing for what you keep. So, for example, if you have basic, you have to make sure that you sign to retain it. And why is that important? Because I've encountered people that inadvertently dropped basic too. And you don't want to do that because, as Ed mentioned, if you've had it for at least 5 years prior to when you retire, and let's say you retired at 65 and you had it for 5 years, under a 75% reduction, you're going to get a chunk of that for free. So don't ever drop things accidentally. And I've been counseling people on that form for 35 years. Remember, you're signing for what you keep, not for what you drop. You are re-electing. And sometimes people get confused on that. So had to jump in on that, Ed, because that's something that I've just been working with for a bit. And Ed is absolutely right. Keep an eye on those increases, because here's what happens. You spend your day doing your jobs. You spend your day looking out for all the stuff that I don't have to look out for, because that's your job. This is my job. So this is why we do this. So we have this information out there, so it's relatively easy for you to get, and just understand that these things are happening in the background if you're not watching them. So that's what we're trying to do. So, Ed, let's wrap it up with option C, because that's family coverage. And I know you have some great family coverage stories of people hanging on to it for a long time. So take us through the changes there.
Okay, so an employee, again, who's enrolled in the basic insurance amount has the option of getting life insurance coverage on a spouse and a child who's under the age of 22. And the way it works is as follows. An employee could get this option C coverage on a spouse. How much? What's called multiples, up to 1, up to 5, up to 5, multiples of $5,000. So you could get a life insurance coverage on your spouse of $5,000, $10,000, $15,000, $20,000, or $25,000. And if you have children, you can get multiples 1, 2, 3, 4, 5 times of $2,500 on a child. You're buying what's called multiples. You're buying multiples. And what you're paying for is the life insurance on your spouse and child, depending on how many multiples you choose. But here's what employees have to know. That what you're paying every pay date, depends on your age. Not the spouse's age, not the child's age. So if you have a much younger spouse, definitely your children are younger than you, you're paying based on the premiums based on your age. Not as opposed to, let's say you went out and bought an individual life insurance policy, or your spouse did, I should say, and they pay the premiums based on their age, not your age. You have to keep that in mind. And one other thing here in terms of children. As I say, this option C coverage for a child, or children if you have more than one child who's under the age of 22, the coverage stops when the child becomes age 22. When your child turns age 22, that child is no longer insured under option C. And the reason I'm bringing this up, Dan, is that I know when it comes to the federal employees' health insurance, and I know this happened to me because I have 4 children. When a child is no longer eligible for the federal employees' health insurance, and when my children were of age, at that time, the limit was age 22. This was before the Affordable Care Act. I would get a letter from my federal employee health insurance company saying, "Dear Mr. Zurndorfer, we note that your child has reached, or within a few months is going to turn age 22. Please note that that child is no longer insured under the federal employees' health insurance. They got to go out and get their own health insurance." And that happened with every child. Now it's age 26 under the Affordable Care Act. But here's the point I want to make. There is no such letter that the Office of FEGLI will send a parent about the fact that their child's turning age 22 and they have to remove them, fill out the form SF2817 and remove that child from option C coverage. If they don't fill out that form SF2817, the payroll will continue to deduct the premium cost for life insurance coverage on that child. It's going to continue when in fact the child is not enrolled. This is a true story. I was doing a retirement seminar. It was not in the DC area. I think it was in North Carolina at the EPA. This was about 3 years ago. And a gentleman sitting in the audience, I was talking about this option C coverage. And he comes up to me during break and he says, "Gee, I didn't realize that my 2 sons are no longer enrolled under option C." I said, "Oh, you didn't get a letter?" He said, No one told me anything. And my sons have been enrolled under option C from day one, ever since I became an employee. And I said to him, "How old are your sons?" He said, 42 and 48.
Oh, boy.
I said, "Sir, you have been paying premiums now for over 20 years on your 2 sons that are no longer insured on option C. So what do?" I said, "Guess what? You fill out form SF2817, submit it to the Office of FEGLI as soon as possible, because you are due a refund of those premiums you paid ever since they turned 22. You're going to get that money back." I hope he did that because he's going to get a lot of money back. 20 over 20 years worth of premiums paid on those two sons. So many employees are not aware of that. And
Gotcha.
the reason they're not aware of it because the office and this I got to admit I'm disappointed. Why doesn't the office of FEGLI send out a letter to these parents? They have a record of the child's age. They should do that, just like the federal employee health insurance companies do. So, all right. So in terms of cost, is what you're buying here. What if someone who's enrolled in option C is paying for those multiples? Like if you have 5 multiples of $5,000 on a spouse, and you have the same multiples on a child, so that's a total of 10 multiples. You're paying us for each multiple a certain amount. And to give you an example here, if an employee is 40 years old, under current rates, they're paying 41 cents every 2 weeks per multiple. So if you have 10 multiples, they're paying $4.10 per multiple, $4.10 every pay period. When they reach 45, it goes up to 59 cents per multiple. So they're paying $5.90. Again, if you have 10 multiples, you have 15 multiples, you have 20 multiples, whatever number it is, you're paying for each multiple, a certain cost depending on your age. What's going to happen after September 30th? The costs are in most cases going to be decreased for people who are under age 69 and younger. For employees who are 70, between 70 and 74, it's going to stay the same. But starting when they're employees who are at age 75 and older, it's going to increase. The cost per multiple is going to increase for option C.
Gotcha. Well, brother, I say this over and over again. I don't know how. I really don't know how you keep tabs on all of this, but I'm glad you do it. I'm glad you do it with us, and I thank you for that.
I can just say one more thing about the FEGLI.
Please do.
That is very, very important, and I point this out during the FEGLI webinar, and it's worth repeating here now. It's very important that those employees who did not enroll in FEGLI when they were first hired, maybe they did enroll but they dropped out, unless there's an open season or a life event, they cannot get back in. FEGLI OPM rarely has FEGLI open seasons. The last open season for FEGLI was held exactly 5 years ago in September 2016.
Gotcha.
2016. So there were employees who took advantage of that open season. And what is the advantage of open season? With an open season, you're guaranteed coverage. You don't have to go through a medical exam. You don't have to prove that you're insurable. You're guaranteed coverage. There are some employees who had just the basic insurance amount, the basic insurance in September 2016, and they added during that month the additional coverages. But here's the point I want to make, that anybody who enrolled in FEGLI during that month of September 2016, anybody who added to their FEGLI coverage, the additional coverages, the coverage did not take effect until October 1st, 2017.
Gotcha.
They did not have any FEGLI coverage, or they didn't have the additional coverages until a year later. We mentioned earlier, in order to keep your FEGLI for retirement, or any part of it, including the optional coverages, you must be enrolled in those coverages for all of the last 5 years.
Gotcha.
Of your federal service ending on the day you retire. The point I want to make is that anybody out there who enrolled in the FEGLI during that open season who are added to their coverage, if they want to retain the FEGLI basic or the additional coverages in retirement, the coverage they added during an open season, in retirement, they cannot retire any sooner than October 1st, 2022.
Makes sense.
Because that's the 5-year anniversary of their coverage taking effect. It's very important. If they retire before October 1st, 2022, they're eligible to retire and they do retire, any coverage that took effect on October 1st, 2017 cannot be carried into retirement because they would not have fulfilled the 5-year rule. It's very important that they note that.
You know, that's a great point, Ed, because typically when they make changes, especially with cost reductions, a lot of times they do accompany an enrollment period, and that's not happening here. Folks, we started this podcast on a somber note, so Ordinarily, I'd be talking really fast and plugging all the things we do. I'm not going to do that. We're going to go out quietly because, again, thoughts and prayers to just our fellow Americans that were affected by the wildfires and Hurricane Ida and the new hurricane that's bearing down on the Gulf Coast, but especially our feds. So we're gonna have a moment of just being quiet here, and then I'll just say goodbye, and we'll see you the next time. So. Okay, folks, thank you for listening. Stay safe. It's your FedLife. Make it a great one because you deserve it.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.